Good afternoon. Welcome to this webinar by NBS Knowledge Lab. Today's topic is on green and sustainable finance, investments, banking, and FinTech. Thanks for joining us. Okay. Today we have four very influential speakers in different areas. They are going to talk about this topic from different perspectives, and I really appreciate their support. I'm very happy to serve as the moderator today. My name is Tao Chen, an associate professor in banking and finance at NBS NTU. I was very excited to note that for this event, we have over 500 registrants from over 30 countries. Very remarkable. One note is that if you have any questions during the webinar, you can type in the Q&A box. And at the end of the webinar, in the Q&A session, we try to answer them as much as we can. So at the beginning, I want to conduct a poll, okay, a very simple one, 2 questions. Okay, I'm running the poll now. Can you see the questions now? So these two are just the hypothetical questions. Okay, we just want to know your preference. You have probably 20 to 30 seconds to complete them. So in the first one, as a consumer, would you be willing to pay more for a product that you perceive as superior ethically? The second question, from the perspective of an investor, are you willing to pay more to invest in socially responsible firms? Okay, we know that green and sustainable finance, okay, is linked with the several other terminologies like ESG, which is environmental, social, and governance, CSR, which is corporate social responsibility. Sustainability indeed has become a mainstream in the business practice of firms. In a recent survey by the UN in 2019, 99% of the CEOs from large firms believe that sustainability will be very important to firms' future success. That is a global trend. Locally in Singapore, with the vision to become a future regional green finance hub, Singapore has launched, okay, recently a couple of initiatives. I just list down a few here, which includes globally the first grant scheme for green and sustainability linked loans in November 2020. And also a guide for the climate-related disclosures by financial institutions, and green trade finance transactions, and also direct funds for the green investments earlier this year. Okay, before I introduce the 4 speakers today, let's see the results of the poll we just conducted. So basically, for the first question, right, we have about 58% who choose yes. Okay, in the second question, we have about 43% of the audience choose yes as well. Okay, very interesting. Okay, so today we have 4 speakers, right, as I mentioned earlier. So this first one will be Mr. Kwok Hui-Sung, Executive Director of a Green FinTech from Monetary Authority of Singapore. The second one will be Rachel Till, Head of a Futures Unit from GIC. The third speaker is Wei Han Ang, Senior Country Business Manager from JP Morgan. The last speaker will be Mr. Benjamin So, co-founder and managing director of STACS. So now I'll pass the time to our first speaker today, Hui-Sung.
Good afternoon, everyone. Let me first thank Nanyang Business School for inviting me to speak, and to everyone for joining us today. The fact that all of you are here today, I think it is a pretty safe assumption that everyone here knows that climate change is a defining crisis of our time. So I will not be emphasizing on why global climate actions are important. Today, the topic of sustainability and climate actions are on the scripts of governments, officials, and business leaders, and the headlines of media. Some may say that these are all only talk and hype, more form than substance. I agree that that is mostly true in relation to what we are doing today and what we still have to do. But hype is a necessary step in the process to gain awareness and mainstream interest, and we must take advantage of that. But hype cannot last forever, so if not, distrust, despair will set in. We need to start translating talk into action. So today I will focus on framing the issues and challenges around the motivations to act and the enablers that MAS has and plans to introduce to accelerate the sustainability focus in the financial sector. I see three main motivations that can drive action. Since companies are made up of people, I believe that they do have social conscience and a desire to do good. Even if it's not for altruistic reasons, companies are looking at social responsibility more as a business necessity to build a strong reputation and to attract talents that today are demanding for greater purpose and a support for social good. However, we know that social conscience alone is not enough. Climate actions cannot be just driven by philanthropy. The core purpose of business existence is to make money. We must address the economic and financial motivations for these thoughts to become tangible actions. We know that there is a growing awareness and advocacy of environmental issues and increasing preference for greener investments and products among consumers and investors. A recent survey by Fidelity highlighted that 57% of people in Asia wanted the money to make a positive change in the world, and 66% of Singaporean investors would consider sustainable investing if they are made more accessible. But of course, we can't trust surveys completely, as when it comes to putting money where the mouth is, many investors will still look at investment returns. There are research studies that has found a strong correlation between market performance and ESG ratings. We hope that continues to be proven. Then the ability to make positive impact while making money will further incentivize focus on ESG issues. Beyond investing, there is also a need to better understand how the economics behind financing, insurance, and other financial products can align with green and sustainability agenda. We also need to be aware that climate changes will threaten financial resilience and longer-term prosperity. These risks include physical risks, transition risks, liability risks, and collectively a systemic risk, given how interconnected our economies and sectors are. These risks are not black swan events. The issue isn't the lack of awareness, but whether there are immediate motivations to act. As Mark Carney, former governor of Bank of England, has put it, it is a confluence of the tragedy of the commons and the tragedy of the horizons, where the financial materiality of a future event is beyond our business cycle and political cycle. The challenge we face is thus to be able to express these opportunities and risks into economic and financial terms that are relevant to a company today. This part of the work is still nascent, but will be critical for sustainability goals to be met. But some argue that government oversight is the only way to correct the years of market failures in driving climate actions. Former BlackRock head of sustainability investing, Tariq Fancy, is one of them, and he has been quite vocal that what we need are systemic solutions at government policies level beginning with carbon pricing and more aggressive regulations, for example, putting a stop to high carbon emission industry and businesses. Others argued that regulations need to be implemented gradually so that it can support a smooth transitioning without causing a sudden and domino collapse of industries and economies. Also, such regulations can only be effective if it is implemented consistently across all jurisdictions. How much we use policy as a market corrector or deterrence, and how much to leave it to the market forces is a complex question that cannot be answered today on this forum. Next, I'd like to talk about enablers for action. MAS has put in place a Green Finance Action Plan, which aims to support a sustainable Singapore and to facilitate Asia's transition into a sustainable future. The plan focuses efforts in these 5 areas. First, as part of the efforts to strengthen the financial sector's resilience to environmental risks, we have issued a guidelines on environmental risk management last year, and will step up non-financial disclosures to be applicable to all FIs. Second, MAS is working with our financial sector to develop green financial solutions and markets that can support a sustainable economy, and has launched grant schemes to support corporates of all sizes in obtaining green and sustainable financing, and to encourage banks to develop green and sustainability-linked loan frameworks to make such financing more accessible. We have also established Singapore's Green Finance Center with the Academia in October last year. This is Singapore's first research institute dedicated to green finance research and talent development. Together with the Green Finance Industry Taskforce, we have launched a consultation paper earlier this year on taxonomy for Singapore-based financial institutions, and to put in place a common language to ensure financing continues to flow to transition sectors. Lastly, we have also earmarked $50 million out of $250 million of our financial sector technology and innovation grant scheme to support the development of green fintech solutions and projects. Regardless of motivations, in order to be able to effectively monitor our commitments to sustainability, translate the risks and opportunities into financial and economic terms, or to set and regulate carbon pricing, the accessibility to quality ESG data goes right to the core of the issues and will underpin many of our sustainability efforts in the financial sector. Technology solutions can help to address challenges in obtaining trusted, granular data to support high-quality disclosures and effective financing decisions. MAS launched Project Greenprint recently, which comprises a series of public and private initiatives to harness technology and data to enable greening of the financial sector. These initiatives include a greenprint marketplace to match international investors and venture capital to green technology providers and other ecosystem stakeholders. It also includes a number of greenprint data platforms as horizontal enablers to support a data-driven ESG ecosystem. It also includes a series of projects and partnership with the industry to focus on real-world ESG use cases across a variety of industry sectors. In summary, I'd like to emphasize that financial sector has the responsibility to take a leading role in the global transition efforts towards a low-carbon future, given that the capital have a huge influence on the actions of the rest of the real economy. To support financial sector to do that, quality ESG data matrices needs to be acquired and developed from real economic projects and activities. MAS will continue to play a constructive and facilitative role in building the interlinkages within the broader ecosystem and to drive greater technological innovation within our fintech industry. Thank you. I think next we'll pass time to Rachel from GIC.
Thank you, Kwek Sin. I hope you all can see my slides. Yeah, good afternoon, everyone. Thanks for joining us today. I will share GIC's sustainability beliefs, which guides us as to how we approach sustainability in our portfolio, as well as how we address climate change in our portfolio. First, sustainability is integral to GIC's mandate, which is to protect and enhance the international purchasing power of our reserves that has been placed under our management. And we believe that actually companies with good sustainability practices are expected to deliver good risk-adjusted returns over the long term. And this relationship will strengthen over time. Like what Kwek Sin said, it is not just about a social responsibility, but sustainability has financial relevance. The next investment belief that we hold is that it is more constructive to support companies in their transition to a low carbon business model or more sustainable business model. That it can be done through bottom-up engagement with companies rather than just divesting out of whole sectors, which reduces our influence to encourage the companies to transition. And finally, we take a holistic and long-term approach when integrating sustainability into our investment process. What does this mean? It means that we not only look at environmental issues, but we balance it with what does it mean for financial issues, financial costs and social issues that affect the company and the community that the company operates in. We also look at climate risk from all aspects, not focusing just on transition risk, but also physical risk, which I will share more later. And finally, when thinking about addressing climate change in our portfolio, we take a holistic approach to integrate climate change considerations at all levels of our investment decision making. We see climate change really as a material investment risk that investors need to manage. It affects investments through three broad channels: physical risk, transition risk, and market risk. The first two are very familiar with many of us, so I will not go into details. More information can be found on our website where we publish our thinking on these topics. But I want to highlight market risk as an impact channel because it is not commonly discussed. And there are two effects here. First is whether markets will price in future climate-related risks, be it transition risk or physical risk, into markets pricing today. For example, will long-term physical risks that affect investments post-2050 be made relevant by market participants because they've incorporated into market pricing today? And will this pricing in mechanism be smooth, and when will it happen? These are uncertainties that investors have to grapple with. Another channel would be whether markets will overreact when they start pricing in future climate-related risks. It is quite easy to articulate, as I did just now, regarding the channels of impact from climate change on investments, but it is quite challenging to quantify their transmission paths to markets and the macroeconomy and to our portfolio. And the evolution of each of these factors are quite uncertain going forward. So for long-term investors, what we do is we take a scenario analysis approach, which provides a systematic framework for us to navigate this uncertainty. And in addition, scenario analysis is also required by international bodies like the TCFD, Taskforce for Climate-Related Financial Disclosures, to stress test their portfolios against the 1.5 degrees world. So here are three climate scenarios that we have developed. The first is a Paris orderly scenario where there is early climate actions and markets price in climate change and transition risk very smoothly. This scenario sees global warming being kept at 1.5 degrees Celsius. The second scenario is a delayed disruptive transition, or I call DDT, and this will see the world delaying on taking climate action. But when a series of extreme weather event hits and it raises public pressures, policymakers have to act, and they have to take strong policy actions to mitigate climate change. Because the policy actions are going to happen later, they need to be larger in order to keep global warming below 2 degrees Celsius. market price in these climate-related risks in this scenario in a very disruptive manner, and there are overreactions and sentiment shock. The last scenario is a failed transition scenario where there is no more climate actions beyond what has been implemented today. And we see global warming rising, global average temperature increasing to 3.8 degrees Celsius. Markets price in future related risks, including those beyond 2050, within a much shorter time horizon. We run these scenarios through a macro and financial model to look at how it affects macroeconomy and asset classes. And we do this and we take a very long-term perspective when assessing the impacts. First, as you can see from the chart on the left, there is a negative impact on growth, and that is largely due to climate physical risks. And this is because of the impact of rising temperature on labor and agricultural productivity that is large and prolonged. You may also notice that transition impact on growth is actually positive. This indicates that government actions to mitigate climate change, such as by setting a carbon tax, could actually have a positive impact on growth. And this is due to two effects. First, government policy can support and stimulate innovation and investments in a green economy that is conducive for growth. And second, there is a recycling. There is a potential to recycle carbon taxes by the government back into the economy by lowering other income and corporate taxes or spending on the green transition. After modeling for the macro effects, these are inputs into the asset class models where we generate what would be the long-term expected returns. And we see here the capital market lines for asset classes across the three scenarios versus a climate uninformed baseline. We see that expected returns on asset classes are lower across the scenarios. Riskier assets like private equity and listed equities are more affected by climate change. Bonds and cash are more resilient. We then run these expected return numbers for any, we can do that for any investment portfolio, but we run the numbers and show the impact on climate change on a hypothetical portfolio with 60% global equities and 40% fixed income, just to see how big and material these effects are. Over a 40-year period, the impact on climate change is material. Returns are lower by an annualized 20 to 90 basis points, which is the chart on the left. This difference might look quite small, but if you accumulate it over 40 years, the total return on this hypothetical portfolio could be 10 to 30% lower than what you originally expect. And this is significant if we are depending on these portfolios to finance our future spending or retirement. What are the implications of the scenario analysis for investors? In GIC, we integrate climate change holistically in our investment processes across all levels. So I'll just share how we do that in a few ways. First, at the top down is strategic asset allocation. We look at how long-term capital market assumptions are affected by climate change drivers in different climate scenarios. This is an important forward-looking assessment that helps GIC better prepare for the range of upside and downside risks that could affect markets. It is also aligned with our belief that we should prepare for rather than try to predict the future. In risk management, we use the most disruptive climate scenario as a stress test for the resilience of the portfolio and consider how we can better navigate through the volatility. The scenario analysis also provides us with granularity in terms of which countries and which industries are most affected and allow us to conduct deeper dives and studies into these countries, these areas in our portfolio. Finally, we also use climate scenarios and outputs to analyze the impact at the company level. For example, forward-looking carbon prices that we simulate can be combined with data on companies' carbon emissions to estimate the impact of carbon taxes on the company's earnings. And finally, in managing climate change as an investment issue, we don't do this just defensively, but we see many investment opportunities that are arising from the transition to a low carbon economy. Across our portfolio, our teams are investing in themes like renewable energy, green hydrogen, electric mobility, sustainable agriculture, green buildings, and so on. I hope this presentation gives you an insight into how climate change is being managed internally in GIC. It is a material investment risk, and we are approaching it holistically across all our investment processes. And finally, just before I end, if you would like to have know about more details about the work we have done, do visit our thought leadership platform called Thingspace, where we publish our thinking and analysis on topics like climate change and sustainability. Thank you. I will now pass the time on to Wei Han.
Hi, thanks, Rachel. Hopefully everyone can see the slide. I would like to also thank Prof. Chen for inviting me to this webinar. I'm Wei Han Ong, Senior Country Business Manager in JP Morgan for Southeast Asia, and would like to take the next few minutes to just share with you what we see from a banking space. Just to start off, I definitely agree with Craig Sin's comment that financial institution plays a leading role in terms of the world's effort to deal with climate change. And in JP Morgan Chase, we're no different. We are actually very focused on this topic, and I will run through a few pointers on some of the slides that we have. But I think first and foremost, banks are corporate citizens like other companies. It's very important that we focus on our physical operations and the environmental impact of our operations on reducing carbon emission and dealing with climate change. So I think if you look at the next slide, I think our operational sustainability is one of our key focus. JP Morgan operates in more than 100 countries, and in the US, we actually have close to 1,000 retail bank branches and many data centers across the world. We are a big power energy consumer, and I'm glad to say that over the past few years we have been addressing some of the sustainability of our operations, and in 2020 we actually achieved carbon neutrality in all our operations globally. So that's a big step forward, and we have done that through improving efficiency of energy use, as well as sourcing of renewable energy to support our power use. And last but not least, carbon credit certificates or carbon credit offsets, which I'll talk about it a little bit later on what are the development that we see in that space. So across those three, we were able to achieve carbon neutrality in our operational sustainability matrices. But to keep us there, I think there's a few things that we need to do, right? We need to continue to source for renewable energy. We have a target of by 2030, 100% of our global power needs can be coming from renewable energy source. We need to reduce our greenhouse gas emission by 40% by 2030. We are also looking to transition our vehicles into electric cars by 2025 and reduce office paper use going forward. I think those are just something that a good corporate citizen should do, and banks are no different. But let me move to the more relevant topic for this webinar, which we talk about. I think that's the sustainable solution and financing. I think across the past 12 to 24 months, increasingly I see banks doing three roles in this space. And let me run through those three roles, not in particular order, but in terms of importance from our perspective. I think one, as per this webinar's title, we need to be a financier. We need to finance our client for sustainable solutions and their carbon transition. And I think if you look at estimates that's made by different institutes, by the UN, and it's carbon transition is an expensive exercise, right? I see an estimated cost that says that it requires 3 trillion annually till 2050 for us to deal with climate change. Other estimates have different numbers, but everything is in the trillions of dollars, right? So it's an expensive exercise, and that's where banks are important, right, to mobilize private capital. Besides government funding, taxes, incentives, as I think Greg Sin highlighted some of those, I think it's important that banks play the part to mobilize private capital towards that effort, right? So I think in terms of the financing, it's very important that banks be very conscious about how they think about sustainable solutions and financing those solutions going forward. And I think JP Morgan, I would like to highlight some of our Paris-aligned financing commitment, as well as our sustainable development target. In our financing portfolio, we actually identified 3 particular industries where we will focus on helping them to reduce their carbon intensity. Right? I think the first one is oil and gas, second one is electric power, and the third one is auto manufacturing. I think question might be asked as to why we picked those 3. And I think hopefully it's clear to everyone in the audience that these are the highest carbon emission industries. I think, you know, a lot of people that are thinking about green finance, I think it's naive to say that we only finance solar panels, we only finance wind power and hydropower, right? I think it's important that we focus on the existing fossil fuel industries and help them transition. Not doing that, we will not be able to achieve the Paris alignment or Paris Agreement for 2050, because, you know, again, there are various projections of the world's energy use, and it's projected that by 2050, 50% of our energy use will still be from fossil fuel, right? So we are transitioning. We are not removing fossil fuel now. We wish we can, but I think it's going to be a long drawn process, and it's important that banks play the part to help some of these industry transition. And JP Morgan, we see ourselves playing a big part on that, and hence we have this Paris-aligned financing commitment on these 3 industries and help them reduce their carbon intensity. There's also a lot of science involved, right? So we've developed our carbon compass to help them transition their industries and reduce their carbon emission to align with the Paris Agreement. There's a lot of science in it to make sure that we look through different scenarios and how do we actually help them to achieve that. So I think that's the first commitment that we've made as a bank perspective. The second one that complements the Paris-aligned financing commitment is our sustainable development target. I talked earlier about, you know, trillions of dollars needed. I think JP Morgan, we have set a target of $2.5 trillion over the next 10 years to address climate change and sustainable development, of which $1 trillion will go to green initiative. Those 2 goes hand in hand to help us help our clients to transition towards a carbon neutral environment. And then the third one I mentioned earlier about our own operational commitments. So I think that's the first point I will talk about. Banks as a financier, what do we need to do, right? I think Kwek earlier also mentioned about environmental risks. That's another topic that not just in Singapore, I think globally we've seen many regulators have set up environmental risk guidelines for banks to follow. We don't see that affecting how we actually support our clients. I think banks, we are good risk managers. We will actually look through those guidelines, make sure that we have adequate risk appetite to support our clients on their environmental transition, particularly those from the brown industries that I just mentioned. I think the other key role I see banks playing is an innovator. I think some of you guys have been following news. There's green bond, sustainability bonds, sustainability linked notes. And we see more and more of those. I see that's a positive thing. Banks are going into innovating our financial products to suit our client needs. JP Morgan is no different. We've actually created various green labeled structures to help our clients to put their money into worthy causes. We have sustainable supply chain financing that we actually help our clients finance their suppliers, but make sure that we tier the suppliers based on their green ESG rating, right? So I think there's various products out there. I think you'll see more of those coming along, and I think that's a very important part about banks being innovators. And you know, in JP Morgan, we also work with FinTech. I think in the US, we actually bought a startup called Open Invest to help actually some of our clients to use the data that FinTech has to drive their sustainability investment journey, right? So various instruments that we work with either FinTech and clients to make sure that we continue to innovate. And one key thing that we need to work more on is on carbon market. That actually requires us to actually collaborate more, which I switch back to our slide, I think with stakeholders and policy engagement. That actually is a key part of the climate change response. I think it's still very fragmented in terms of the voluntary carbon market. I think to Prof. Chen's earlier poll, we are asking people, are you willing to pay more for socially responsible product? I think if you get a carbon market right, a lot of the non-green products will be slapped on the carbon pricing, and it will no longer be whether you are willing to pay more. Are you willing to pay more for a non-green product, right? I think if you get the carbon pricing right and the carbon market right, I think that will come eventually. But it's a huge effort because every geographies has their own rules, and what is considered a good carbon credit and how is it being verified. I think there's still a lot of discussions and ongoing engagement with different stakeholders as well as regulators on. The third role I would say, increasingly we see banks doing is that clients are looking to us as trusted advisors, right? I think if you ask me 12 months back in Asia, a lot of clients would have, hey, JP Morgan, we have a sustainable portfolio. Can you help me find a way to fund it? I have a green project. Can you help me to fund it? Now we see more and more clients coming to us to say, hey, JP Morgan, can you help me look through all my different lines of businesses and portfolio, and how can I make it work and reduce the carbon transition and have a sustainable future with these businesses, right? And to that end, I think we as a bank, as with other banks, need to continue to learn and develop our capability. We set up a Center for Carbon Transition in the US to help us beef up our knowledge and also help us engage with clients to really empower them and educate them on the transition journey. And that's actually an R&D center that will continue to learn more about what's going on as more science discovery comes on board on this particular topic. Notwithstanding that, I think our research product, again, is important for us to continue to provide our clients, especially investor clients, on a thought leadership regarding sustainable topics, green finance topics. We have actually beefed that up significantly. We do have a research team now here in Asia that publish green finance and ESG related topics. So yeah, I see the note. I might be talking a bit too much, but just recap. As banks, we need to learn more, we need to innovate more, and we need to collaborate more to do the three roles of being a financier, innovator, as well as a trusted advisors of clients better. Let me quickly hand this over to the next speaker, Benjamin. Sorry for taking up some time.
That's all right. Thanks, Wei Han. Thanks, Prof. Thanks to all my fellow panelists and all the attendees. I think today is great because we have been able to hear from the various perspectives from the MAS, large asset manager like GIC, and of course, large global bank like JP Morgan. So for my part here, I'm just going to share how a technology firm like us, a fintech firm like us, could possibly help with all stakeholders in improving trust in green finance. Asset managers and banks have really stated that they are very interested in promoting green investments and green financing. And of course, MAS has a lot of incentives that are laid out for industry to increase green finance. However, we still see that there are various problems in the market, that could possibly be eased by technology, largely the fragmentation of information. On the left-hand side, we see corporates saying that, there's still a funding gap. The United Nations Sustainable Development Goals state that there's a $2.5 trillion gap every year, while individual corporates are telling us, that is expensive and very difficult to get certification. There's just simply not enough certifiers or auditors out there to measure every single building or every single project. Okay, at the same time, financial institutions are facing a problem, okay, when they are trying to finance or invest in a project whereby it is difficult to get the reliable data, and that leads to greenwashing because these various pools of data are fragmented with bespoke methods in different industries. So it's almost virtually impossible to measure end-to-end carbon emission scope 3 today. So from this perspective, okay, a fintech firm like us, we aim to be able to provide a technology platform to be able to overcome this. So this is what we view, okay, what does good look like for all the stakeholders. The end objective is for institutions, banks, insurance companies, asset managers, etc., to be able to mobilize more capital from the private sector to be able to have efficient green and carbon markets. And we feel that in the middle, okay, we need a blockchain-powered nexus, which is where we have started building something for the financial industry, whereby we want it to be interoperable with any sector. We start to see various sectors like the manufacturing, transport, etc., okay, providing information to us. And if we dive a little bit deeper into what we foresee industry ledger could look like, is simply a DLT-based technology layer that will be able to take in information from various sectors. So these sectors, of course, could make up an entire end-to-end value chain proposition, okay, with different segments in between. And on the distributed ledger technology layer, okay, we have programmable smart contracts. Okay, we are of course very encouraged, okay, by what Wei Han mentioned about innovative products where sustainability linked bonds, for example, could be able to trigger financial incentives based on certain KPIs at events. But of course, we want to be able to allow these triggers to be triggered only with credible data. And with digitalization, we enable the portability of such products across various systems and venues. Okay, the information must be interoperable, okay, with any existing current banking system, okay, using industry standard protocols. Okay, depending on the use case, depending on the jurisdiction, there are already a variety of ESG standards and protocols that could be used. And if we roll this up further, we want to be able to aggregate all these specific project data into a rolled up portfolio data, such that a transport and logistics company in one country that is transporting, okay, goods from one location to the other as part of a subcontractor of a large MNC will be able to affect its carbon footprint and therefore affect its rating in a larger portfolio elsewhere. Okay, so we see a lot of this data being used horizontally using, okay, existing services and of course existing partners to be able to leverage on, okay, such aggregation for all service providers and exchanges. So that is the vision that we have as STACS, which is something that we hope to be able to achieve by building this together with industry. So of course we can't do this alone. Okay, STACS is a blockchain development company. We've been in business for a few years now. Okay, but most importantly, we've been starting to work with other partners who are in other technologies. Okay, so we already have partners in the IoT, data analytics, and certification area, and that's where I think collaboration is important for something as big as overcoming the climate change to be able to achieve the Paris Agreement. I feel that a company cannot do this alone. Okay, similarly, we are starting to see very, very encouraging signs that large financial institutions working together, and of course MAS providing a supportive environment for all of us to be able to come together. Okay, and this is what I envision a user journey to look like. So currently, okay, we are already involved in a few different sectors today, where we see transport and logistics fleet owners, okay, or manufacturing factories and plants, or certain buildings of a portfolio are already sending information to us through various means. So this could be sensors or IoT, and the screenshot will look something like this. This is an actual live screenshot. Okay, such that all the data, okay, could then be measured and also create actionable and meaningful reports. So these reports could be used for various purposes. On the left-hand side, you see that we'll be able to try to use these reports for better financing. It could be a green bond or loan. Okay, it could be for a impact reporting of an investment portfolio, and it could be simply getting a better policy underwritten by insurance company. Okay, or it could just simply be carbon emissions calculation if, okay, we are trying to prove that we are avoiding carbon such that we can create high quality carbon credits. So these are certain screenshots that we already have where we want our platforms to be able to plug and play into multiple types of industry standards and calculate scope 1 to 3 emissions. Of course, at the end of the day, okay, it just needs to also have the real certification of existing industry standards. So that's why we are working with certification partners to be able to see all this data that is being collected reliably, and such that these industry certification partners can now turn this around quickly. I was very surprised, or rather shocked, to know that in a country like Thailand, for example, there are 9 million buildings, but only 100 certifier providers. So if you want every single building to be certified, it's just going to take simply too long. And in the climate of COVID, for example, with lockdowns and immobility of people, okay, we want to be able to make sure that, okay, this could be done using a technology platform. So once these certifications are done, or if carbon credits are calculated, okay, we want them to be able to interact with the smart contract so that we could enforce financial incentives, as you mentioned, or create carbon credit tokens that could only be used one time. Okay, and all of these are interacting on a smart contract stored on a blockchain-based ecosystem that is connected to all the institutions and participants. So this is what it will look like. It's something that we already have, okay, such that institutions, investors, and investors, okay, could now also, okay, use and access this platform. Ultimately, we hope that, okay, this is the final slide. Okay, we hope that through the use of technology, okay, we are able to deliver a one-stop solution for asset and wealth managers and investors to now be easily able to access, okay, real-time data, okay, such that there is always a real-time monitoring and reporting of companies' sustainability commitments. For banks, financing providers, for insurance companies, okay, we hope to be able to provide greater confidence in ESG and allay the fears of greenwashing, okay, simply because some people have said that, there's when you are trying to apply for a loan, you are always green because you got the certification and all those marks that are required. But what about ongoing? Okay, there is simply a lack of data that is from an ongoing perspective. Okay, so we want to hope to be able to provide this continuous tracking of commitment towards KPIs. For corporates, ultimately, we want to be able to provide a digital platform that simply lowers the barriers of entry. Okay, some people have said that sustainability is only for the larger corps today. Okay, which is not true, because we do hear of smaller size, medium size corporates who are trying to get into sustainability, but simply not having the access, simply because maybe they could not book the certification partner, or simply because there isn't a technology solution that could create lower costs and efficiencies of scale. So through this collaboration with both the financial industry and the non-financial industry technology parties that we are connected with, we hope that together we could provide a technology platform working in tandem with the stakeholders to promote green finance. Thank you very much.
Okay, thank you all for all the wonderful speech and many insights that we have as well. Okay, so I want to thank you individual as well, Kristen, Rachel, Wei-Han, and Ben. Okay, all wonderful speeches. Okay, now we have the Q&A session. Okay, and I'm a little bit overwhelmed by the number of questions raised. Okay, I'm trying to consolidate, okay, some of the questions. Okay, so let me just for the first question, probably I'll just deliver to Kristen. Okay, according to the order of the presentation. Okay, so one question is that promoting ESG could be costly for the firms. Okay, and what if the firms don't perform well and ignore ESG? Okay, how to solve the problem, and how regulators probably can help in this sense as well. Yeah.
Yep. Thank you for the question. I think we look at it in a few levels. Okay, first of all, I think it is clear that more regulations will come into play. All right, not just Singapore perspective, but globally. All right, how fast we implement those regulations, I think is a matter of how we ensure a smooth transitioning, as I mentioned before. For example, carbon pricing. Okay, I think the signaling is already there. All right, that the right carbon pricing, okay, suggested could be $80, $100 or more. All right, and that will come into play pretty soon. All right, and second, I think the requirements for financial institutions to start doing disclosures, I think the signaling is also there. All right, many has already started without us mentioning it, but I think the important part is how do we align and standardize some kind of this reporting to make it comparable across. All right, but beyond financial institutions and listed companies, I think the expectations is also there. All right, today. I think many corporates are already submitting financial reports, okay, to regulators. It is not unimaginable that this will be required. Okay, corporates will be required, okay, to submit non-financial disclosures also to regulators as they are incorporated in those countries. But beyond regulators, I think there's also expectations, okay, at the business side. For example, in applying for a loan facility, all right, banks are requiring you to do disclosures as well. So if you don't do it, all right, or you ignore it, okay, it means that your accessibility to those loans, okay, might eventually be more and more limited. We know of European countries that are setting requirements for procurement, okay, saying that if you want to be a vendor of mine, you have to do disclosures to me, all right? And this is not going to affect only large companies, okay? Smaller companies, SMEs who want to bid projects, okay, with larger firms, governments, okay, eventually would have to do their disclosures in order to be able to participate in the business. All right, so all the signaling is there. Okay, if you ignore it, it just means that you have less time to react in the future. All right, thank you.
Okay, thank you, Christian. So the second question I will deliver to Rachel. Okay, so you talk about the one question is that you talk about the green investments in terms of the forming the strategies for example, the related to the climate change, etc. Those factors, right? Do you consider the differences between developed countries and emerging markets in forming the investment strategies? Yes.
Yes, thank you for that question. Indeed, we look at the impact of climate change across the whole portfolio and in all the countries that we invest in. And we do invest in the emerging markets as well. And the analysis is conducted actually at a granular level, country by country and industry by industry. And we do see in transition opportunities in the emerging markets. In fact, the potential for growth of transition in emerging markets are much bigger. If I take a 20-year view, it's much bigger than in developed markets, which already have a lot of them have transitioned and starting from a higher base, from the present day forward. So yes, we do take into account the transition opportunities in emerging markets as well, and in all the themes that I mentioned in my talk earlier. Thank you.
Okay, thank you, Rachel. So thirdly, the question I will give to Wei Han. Okay, so one question is about specifically to GPM. Okay, so just not to borrowers. Okay, not only to borrowers. Is there a sustainable ranking or rating in the bank's mind that you will give a preference to when basically considering different suppliers, vendors, or partners? Will you consider ESG ranking or rating to give some preference for those who are more sustainable in terms of suppliers, vendors, partners, etc.? Yes.
Yeah, thanks for that question. I think the answer is yes. I think if we're talking about JP Morgan internal operations, I think it's quite clear for us that for us to achieve and continue to be carbon neutral and to be socially responsible, we've already put a lot of our suppliers through that filter. In JP Morgan, we tend to have what we call a Gold Supplier program, where we actually assess suppliers, not just ESG, right, on resiliency. I think it's quite useful if you think about the recent COVID situation. A lot of our suppliers have to be resilient, and cyber and technology controls, again, very topical. If your suppliers or people that you work with are breached, chances are you will be breached. So various factors, and ESG is not something new. So we will and we have already put those through the filters and make sure our suppliers who actually work with us are equally socially responsible, if not more than us. Hopefully that answered the question.
Okay, thank you, Wei-Han. So next question I will give Ben. Okay, for one question is, there are several questions actually related to the ESG data management. So Ben talked about the real-time data from the FinTech side that FinTech can help in this case, right? Can you just give one tangible example or project that you guys are doing? Yeah.
Sure. So we already see some sensors being placed in logistics trucks, okay, because these logistics trucks actually travel a lot every single day, and they're transporting goods from one place to the other. So they're actually forming part of the value chain. So your material may be sustainable, your building may be sustainable, but if you're transporting materials from one place to the other in a highly inefficient manner, actually that forms carbon emissions under Scope 3. So that's where we want to be able to deliver the complete picture, especially for a lot of large. In Singapore, it's really quite interesting that any large corporate has a regional footprint. Okay, and that's where this transport and logistics sector will be able to really fill the missing gap. Okay, whenever there's transportation being done from one place to the other. So that's where this data is really vitally important. There is a way to minimize these carbon emissions, and of course, there is a way to report it if the carbon emissions are actually quite high.
Okay, thank you, Ben. So I think last question probably. Okay, so for all of you probably. Okay, so one question talks about basically, sustainability is necessary and is something to be urgently rectified. Sometimes, there are many multiple layers of compliance and regulation checks, etc. And so basically, the participant talk about, there could be too little efforts, and how to basically to promote those more tangible actions. So this is probably a tough question for all of you. Yeah. So yeah, any of you can speak on this. Yeah.
Maybe I'll start. Ben probably have more to say. All right, because I think we are going on the same point that I think digitalization would be one area. We acknowledge that I think today, okay, there are quite a bit of a, I would say, friction, all right? Friction because things are unclear. Examples, reporting standards, taxonomies are unclear, and we are all trying to figure out things, okay, along the way, all right, while international standards organizations and authorities are trying to agree on a certain alignment. But we can't wait for everything to be settled before starting to do things. So yeah, we are in a state where there are certain things that we need to do, while other things, a lot of moving parts, and also a lot of inefficiency. All right, and we talk about facilitating data flows through technology, and that's essentially digitalization. And I think what we want to work with the FinTech industry is really to look at how we can remove all this friction using technology. Yeah, thanks.
I will just add the 3 things that we are doing and investors should also focus on. First, invest in solutions, right? Climate change solutions like carbon capture and sequestration, which there was one question on, and it is important to do that. We are investing in renewable energy and green hydrogen and technologies that can just help to mitigate carbon emissions in the global economy. 2, invest in the transition. We want to support brown companies who are transiting their business model. So GIC invested with Duke Energy in the US, but the proceeds of our capital is actually helping them to spend on green capex to transition their business model into a greener one in the future. And third, for investors, integrate climate change considerations into your investment processes, right? It has a material impact on earnings, on valuations, and it is our responsibility to do that. Do not outsource this right, to a central ESG function or an external provider, but really engage with the evidence, engage with the developments, and consider them in the investment process, because that will allow you to be more resilient, right, in your decision making. And over time, your portfolio will shift away from brown to green. Thank you.
I'll just quickly add, I agree with what Maxine and Rachel mentioned, but I'll just raise one key point. The faster we can put a price on climate change, the more likely these actions will be done automatically. So, inputting prices of pollutions into industries are quite important through the carbon market.
Yeah, thanks to all the panelists. And of course, as a tech firm, we want to be able to enable all this transfer of information, portability of pricing, and of course, transparent database, okay, such that you will enable better decision making. So I think that will also allow for a more cost-effective way of certifying green for all corporates. Yeah.
Okay, thank you all. Okay, great. Thanks again. Okay, for taking your precious time to do this webinar. Okay, also I want to thank the participants who asked questions. Also, there will be a survey after the after this webinar. So if you have please complete the survey as well. And we had wonderful talks and discussions. Hopefully we can meet in person in the future to continue the discussion. Okay, thank you all today. Okay, that's all I think. Yeah, thank you all.
Thank you.
Okay, see you guys. Yes, thank you.